What's up, everybody, and welcome back to J&J Futures Bootcamp. Today we're going on the start of a little technical analysis streak. Today is going to be on SMT divergences, which aren't required for our strategy, but are heavily recommended and are a fantastic confluence to get you more winning trades in the market. All right, first off, what is an SMT divergence? We're using this picture from T Trades' video on SMTs, which I heavily recommend if you're not fully sure on what they are after this video. He does a good job explaining it with some visuals. But an SMT divergence, the best way I can explain it is the S&P 500 is a group of stocks that you've probably heard of, and they have their own futures contracts. And remember, we're trading futures here. So many people trade the S&P 500 futures. We don't. Our strategy is the NASDAQ just because cleaner price action, less affected by outside factors, stuff like that. But for the most part, the S&P 500 and NASDAQ typically move the same. There's something known as correlated pairs. So most of their moves are correlated, meaning when the S&P 500 goes up, the NASDAQ is probably going to go up. When it goes down, the NASDAQ is probably going to go down. So an SMT divergence is one of those cases where that actually doesn't happen, where the S&P 500 will go down and take out a swing low or swing high. Remember, referencing the liquidity video that we've posted. If you haven't watched that, then please make sure to watch that very important video. Swing lows and swing highs are basically the most fundamental form of liquidity. So, for example, in this picture here, when we come down and we take out this swing low in the S&P 500, but that same swing low does not get taken out on the NASDAQ, meaning there's a liquidity sweep on the S&P 500, but no liquidity sweep on the NASDAQ, that is an SMT divergence because the S&P 500 is diverging or going away from the move that the NASDAQ was doing. The NASDAQ is now no longer following the S&P 500, even though they're supposed to because they're correlated pairs. So what does this mean? This basically means that now a reversal is very likely to come. And as you can see on this chart, right after the S&T happens, price shoots up on both assets. So that's a big key point. When the S&T divergence happens, usually price is going to reverse on both assets. So once again, an SMT divergence is when a swing low or a swing high gets swept by either of the two that the other doesn't sweep, and then what results is usually a reversal. So let's go to the charts and check this out ourselves. On the left here is the NASDAQ, aka what we trade. On the right is the S&P 500. Now, the other day, this is on the 15-minute chart. These can happen on any time frame, but just like fair value gaps, the higher the better. So on the 15-minute chart, we saw this big high that we created from the day before at 7 in the morning. So this is the high right here, and this is that same high right here on the S&P 500. As you can see, on the S&P 500, price came up and took out that high. So that would be an SMT. This high gets swept and taken out. However, on the NASDAQ over here on the left, that same high never got taken out. That is an SMT divergence. The S&P takes out this high, whereas the NASDAQ never got to take out that high. And then what happens on both assets? As you can see, price goes down. For the white candles obviously meaning that price is going down, green meaning they're going up. But as you can see, price goes down heavily. We get a bit of a pullback, but then we continue that downward streak for basically the entire day. And as I said, it happens on both assets. So why is this important? It's really important because using SMTs, although they're not part of our entry model, they can help you find an entry even more. For example, if there's a fair value gap that we're also bouncing off of, which we could technically use this one right here. So we respected that fair value gap right here on the NASDAQ as well. That's dual confluences. And then you would look to the lower time frames to see if you can get an inverse setup. Obviously, this is happening in the pre-market, so it wouldn't be my favorite time to take a trade. And we probably wouldn't have taken this trade, but this just shows that it can really work at any time. We get this inverse fair value gap. we take a short, stop loss, and then you could target any liquidity, for example, the London low. So as you can see, SMTs are extremely powerful, and there are many videos on how to use SMTs for direction or even for entry. Some people enter off SMTs just because of how powerful they are. So one last time, we look at the picture. S&P 500, which, by the way, on futures on TradingView is called ES1 exclamation point. And then the NASDAQ is NQ1 exclamation point. All right, that's it. Now, if you're if you don't have TradingView Premium, or if you don't have a prop firm linked or connected, then you're probably going to have something called delayed data, and that's because you won't have a subscription. The way to do that is either to subscribe to TradingView or to get a prop firm account. That is how you solve that issue of delayed data, sadly. But you look at both ES1 and NQ1, and you watch their movements, and then, like I said, liquidity sweep on one, but no liquidity sweep on the other, enters an SMT divergence, which is a sign for reversal. So yeah, that's how SMT divergences work. Once again, T-Trades has a great video on it that I recommend you guys check out. And yeah, have a good one.